Hi, and welcome to Finextra at Sibos TV. And today I'm talking with Chris Ekonomidis of Sapient, and we're going to be discussing over-the-counter derivatives reform, which is a really big topic right at the moment.
Yep.
So, what are some of the considerations for that regulators need to look at when looking at this legislation?
So I think one of the key things would be around harmonization and kind of taking two different views, looking at the rules and the timing of those rules. So talking about the rules themselves first, I think there's a realization that there won't be full harmonization just given the various market structures that exist. But I think there needs to be a concerted effort to make sure that, I think a couple things. You want to make sure that the rules, there may be rules that are duplicative. You need to comply with the same rule in various jurisdictions. I think that would have an increased cost to kind of multinational firms, and I think any minimization of that, would be a key piece to strive for. I think the other more important piece would be making sure that you don't create rules that conflict with each other within various jurisdictions. I think that would just add an additional level of complexity and cost for multinational firms to go ahead and comply with. On the timing side, I think there's an issue with just making sure that the rules, looking at primarily the U.S., the U.K., and the EU, and how those rules pull together and mesh together as far as an implementation timeline about when things will need to be cleared, what instruments will need to be cleared at what times. I think it's very important to go ahead and align those as closely as possible, just to go ahead and limit potential, opportunities for arbitrage, or, more seriously, looking at business that may leave the country or leave a particular jurisdiction, and then not necessarily having a guarantee that business will come back after the rules, do go ahead and are harmonized. Are implemented.
So what about trade finance and workflows? What are the implications for those?
So I think there's a few different pieces there. I mean, if you look at the move from kind of a bilateral environment for OTC derivatives trades and that migration to a central clearing model, there are a lot of participants that will need to go ahead and shift how they do business. From a buy side perspective, you're going to be much more focused on what that cost of clearing is going to be and how that's going to impact your yields. If you take a look at the sell side, they'll need to go ahead and be able to go ahead and accommodate their clients, both from trading for their own books potentially if that stays around within the existing legislation, and also being able to go ahead and make sure that their clients can have that visibility into the trade life cycle, to go ahead and understand where they are. Have they gone ahead? Have they executed a trade? Has a trade been cleared? What are the impacts to my credit lines? What are the impacts to my collateral and my margin that I need to post? What margin can I post? What margin is eligible for various clearinghouses? I think those are all kind of key considerations. On the back end, you kind of see the reporting of these trades to various kind of swap data repositories or trade repositories throughout the world. I think we've already seen some fragmentation in that marketplace based on different participants that have stated the goal to go ahead and be an SDR. So I think there's a key consideration or a key risk there that this fragmentation needs to be able to flow to the various regulators in a consistent format so that they can go ahead and execute on their mandate to go ahead and lower risk, and make sure that they have the increased transparency and visibility into the market that they need to go ahead and do their jobs.
So what about the impact on market participants? What's coming down the pipeline?
So I think it's from market participants' perspective, I think there's a framework in place. The rules haven't been finalized, and I think there's a lot of questions about what they're going to look like once they go ahead and get finalized. But even with that uncertainty, there is a move to kind of central clearing of standardized products, and firms can they need to go ahead and assess how that's going to impact them from a business model perspective. So what does that mean to them from a strategy perspective? Are there do they have strengths they can go ahead and capitalize on? Do their competitors have weaknesses they can go ahead and capitalize on based on this change in the in kind of trading life cycle and this paradigm shift? I think another piece is looking at kind of operational readiness. So you have some idea what's going to happen. You're going to need more robust systems from a trading perspective, from a risk management system perspective. I think you mentioned collateral and kind of daily margining perspectives. So those are going to need to be key systems that'll need to go ahead and kind of have either be updated or go ahead and be overhauled to go ahead and accommodate this need. There are a lot of firms are kind of going down that path, making sure that their businesses are aligning with what they need to do, taking a look at what steps will need to be taken, and then being ready to go ahead and action that. when the time is right.
Yeah, I think that's true. What you mentioned, I think the OTC markets, derivatives markets, they're going through a paradigm shift for it at the moment. So
Yes. Yep.
that's great. Thank you very much. Appreciate it.
Thank you.
Thanks.